Welcome back, everyone, to the deep dive. This is where we take, those dense analyst reports, the earnings releases. Today, we're looking at SNDL Inc.'s Q3 2025 financials, and we really try to cut through all the noise.
Yeah. Our job today is to find that signal for you. What are the crucial bits of information you actually need to understand SNDL's real financial health? And maybe more importantly, where they're headed strategically. It's often way beyond those first headlines you see.
Absolutely. And especially with earnings reports, right? The first thing you hear is usually, did they beat on revenue? Did they miss on EPS?
Exactly. And those simple yes-no answers, they rarely tell the whole story, especially with a company like SNDL, multiple business lines, some, let's say, unique accounting situations, and operating in a really tricky industry like cannabis, highly regulated, capital's tight.
Right.
So today we're going to use this 5-part framework we've developed. We'll pull apart the numbers and really try to understand what management's actually doing, what they're executing on.
And straight out of the gate, there's this kind of paradox, isn't there? A mixed quarter. They beat on revenue, which is good, but they missed on EPS. That sounds confusing.
It does.
Yet the analyst consensus, looking at our source material, landed pretty quickly on neutral. So what does that initial take tell us, that mix leading to neutral?
Well, I think neutral is the market basically saying, okay, we see potential here. They're promising growth prospects, especially in those retail segments. But those good things are being weighed down right now. Short-term profitability issues, maybe some lingering worries about valuation. It's like the current price reflects both the upside and the hurdles they face right now.
Okay, so we need to unpack those hurdles because you mentioned, and the report suggests, the main reason for that EPS miss might be more about accounting than actual cash problems.
That's exactly where we need to focus. Those accounting entries, they can really distort the picture if you're not careful.
All right, let's do it. We'll start with those headline numbers and then, like you said, pivot to the deeper stuff that tells the real story. Okay, slide 1, the at-a-glance scorecard. Let's start with that headline performance versus the estimates. Give us the details on that revenue beat first. It was narrow, wasn't it?
It was narrow, but still a beat. They reported total net revenue of $244.2 million. The consensus estimate was just under that at $242.98 million. So, yeah, they edged it out.
And in this market, any beat on the top line probably feels like a win. Suggests they're executing okay, demand is holding up.
I think that's fair. In a market that's consolidating, even a slight beat shows some resilience.
But then we hit the bottom line, and that wasn't just a miss. It was, well, it looks pretty significant compared to expectations.
It was, yeah. The diluted EPS, earnings per share, that's the number everyone watches, right?
Yik.
It came in as a net loss of 5 cents per share. That's $2.
And the estimate was?
The analysts were expecting them to break even, 0 cents per share. So missing by 5 cents when break even was the target.
Yeah.
That definitely gets attention.
Yeah, that immediately raises questions for anyone just looking at those headline JAP figures.
For sure.
Okay, let's shift focus slightly. Instead of comparing to Wall Street, let's look internally. How did this quarter compare to Q3 last year, year over year?
Right, the YoY comparison. And here the story gets more interesting, maybe more telling. Revenue growth was, well, modest, only up 3.1%. It went from $236.9 million last year to the $244.2 million this quarter.
Okay, 3.1% growth, not exactly setting the world on fire.
No, but look at the net loss improvement. That's where things get really compelling. The net loss narrowed significantly. It improved by 31.1%.
Wow, okay, so loss went
From a loss of $19.3 million in Q3 last year down to a loss of $13.3 million this Q3.
31% improvement in the loss versus only 3% growth in revenue. That difference is huge.
It is. And this right here, this uncovers what I think is a massive operational positive, strong operating leverage.
Explain that. What does that leverage mean in practice?
It means your profitability, or in this case, the reduction of your loss, is improving much, much faster than your sales are growing. It's like 10 times faster here, 31% versus 3%.
Okay.
That signals the underlying business structure is getting way more efficient. They're managing costs better, maybe getting better margins on what they're selling. Fixed costs are likely being spread over a bigger base. It points towards scalability, efficiency gains, things that are absolutely crucial for getting to actual profit later on.
And these are the kinds of positive operational signs that can get totally lost if you only look at that headline EPS miss.
Completely obscured.
Now, before we dig deeper into why the loss happened despite that efficiency gain, we need to touch on something technical but important. Basic versus diluted EPS. Why were they both the same? That Gil earned a $5 loss this quarter.
Yep.
This trips people up.
It really does, but it's fundamental to reading financials. So basic EPS, that's the simple one. Net income divided by the average number of shares just floating out there.
Oh.
Easy. Diluted EPS is meant to be more conservative. It considers things like stock options, warrants, convertible debt, anything that could become a common share later on.
So it usually increases the share count, which makes the EPS number look worse or lower, more diluted.
Normally, yes. That's the point, to give the most conservative picture of earnings per share. However, there's this accounting rule called anti-dilution.
Anti-dilution. Okay, what does that mean when a company's actually losing money, like SNDL did here?
Well, think about it. If you're losing money and you add more shares to the denominator in that EPS calculation, mathematically it makes the loss per share smaller.
Ah, right. Dividing the loss by a bigger number makes the loss per share less negative.
Exactly. It would actually make the company look slightly better, which defeats the purpose of diluted EPS being the conservative view.
So the rule says you can't do that. If adding those potential shares makes the loss smaller, you just don't add them.
You got it. They're considered anti-dilutive in a loss scenario, so they're excluded from the diluted EPS calculation. That's why basic and diluted EPS are identical at 2000 saw here. The key takeaway for you is, when a company's in the red, dilution isn't really the metric to focus on for the income statement. Cash preservation is king.
Okay, that makes sense. Thanks for clarifying. So back to the main puzzle. If operational efficiency, that operating leverage, is improving so much, why did they still miss that break-even estimate? This must be where those non-cash charges come in.
Bingo. This is the crux of it. The entire GAAP loss story, that $25, it was heavily distorted by these significant non-cash charges. We're talking over $12 million flowing through the income statement.
And non-cash means it's an accounting entry, not actual money leaving the bank.
Precisely. These are things like valuation adjustments accounting for liabilities. They inflate the official GAAP loss figure, making things look worse on paper than the actual cash performance might suggest.
Okay, can we break down the big ones? What were the main non-cash items hitting them this quarter?
Yeah, the report highlights three main culprits. The biggest one was a $6.8 million charge related to share-based compensation. Think stock options and similar awards.
Okay, nearly $7 million there. What else?
Second, there was a $3.9 million non-cash inventory adjustment, basically writing down the value of some of their inventory on the books.
All right.
And third, a smaller one, but still notable, $1.6 million net fixed asset write-off, maybe getting rid of some old equipment or property value adjustments.
That $6.8 million compensation charge? That one seems particularly weird, almost backwards. The source material points out the loss got bigger because the company's stock price went up dramatically, like 121% during the quarter. How did that work?
It sounds completely counterintuitive, doesn't it?
Yeah.
But it's a real feature of what's called mark-to-market, accounting for certain liabilities.
Okay.
They issue share-based compensation, maybe stock appreciation rights, for example. These are liabilities on the balance sheet, and their value is tied directly to the company's stock price.
Yeah.
So when SNDL stock shot up 121%,
The value of that liability on their books also shot up.
exactly. And that increase in the liability translates directly into a bigger expense charge on the income statement.
Wow. So the company's stock performs incredibly well, rewarding shareholders, but the accounting rules force them to book a larger loss because of it.
It's a perfect example of the disconnect that can happen between stock performance, shareholder value, and GAAP income reporting. It really highlights why you absolutely cannot just look at the GAAP net income number, especially for companies with complex compensation plans, and assume it tells you everything about how the business is actually doing.
So accounting loss inflated by stock success and inventory cleanup. Got it. What was the real story then in terms of cold, hard cash? What did the cash flow look like?
Now we get to the heart of it. The contrast couldn't be starker. While they reported that GAAP net loss of $13.3 million, they actually generated record free cash flow.
Record free cash flow. How much?
$16.7 million.
Mm-hmm.
Positive $16.7 million.
Okay, define free cash flow for us again quickly.
Sure. It's the cash generated from the company's core operations, minus the cash they spent on capital expenditures. Things like building new stores, buying equipment. It's basically the cash left over that the company can use for anything paying down debt, though they have none. Acquisitions, share buybacks, or just building up reserves.
And generating $16.7 million of it is good.
It's excellent. It's the lifeblood. It shows the business is actually generating more cash than it consumes. This $16.7 million positive FCF figure, for me, that's the single most important takeaway from Q3. It completely flips the script from that negative EPS headline.
And it lines up with that minimal share buyback activity we saw, right? They only bought back 1,800 shares.
Exactly. They generated strong cash flow, but they didn't rush to spend it on buybacks.
Which signals.
It signals discipline. They have the authorization, they have the cash, but their priority right now is clearly holding on to that cash, that dry powder, for strategic growth opportunities, which we'll definitely get into when we look at their outlook.
Okay, slide 2. The engine of profitability. We've established the EPS miss was largely an accounting thing, overshadowed by record free cash flow. Now let's look at the quality of their sales gross margin. What's the consolidated picture?
So, on a consolidated basis, looking at the whole company, gross profit did grow. It hit $64.2 million, which is positive. However, the overall gross margin percentage actually dipped slightly.
Oh, from what to what?
It went from 26.6% last year down to 26.3% this quarter, just a small dip, 0.3 percentage points, but it suggests maybe some pressure on pricing or costs at the aggregate level.
Okay. But you said earlier that consolidated numbers can be misleading here because of the different segments.
Exactly. That 26.3% consolidated margin. It's hiding some underlying strength. You have to break it down.
So what happens when we look at the main customer-facing segments? Liquor and cannabis retail.
That's where the story changes. Both of those core segments actually saw their gross margins expand. Liquor retail's margin improved by 0.8 percentage points.
Nice. And cannabis retail.
Even better. Cannabis retail margin improved by 0.9 percentage points, almost a full point.
Okay, so the parts of the business actually selling directly to customers are getting more profitable on each dollar of sales. They're managing pricing, cost of goods.
That's what it indicates. Effective management within those established retail operations.
So if the core retail margins went up, but the overall consolidated margin went down, the drag must have come from somewhere else. Let me guess. Cannabis operations again?
You nailed it. The entire reason the consolidated gross margin dipped was because of that non-cash inventory adjustment we already discussed, the $3.9 million write-down.
And that was booked within the cannabis operations segment.
Correct. That single item, that accounting adjustment in one segment, had a negative impact of 1.6 percentage points on the total company gross margin.
Wow. So take that out, and the overall margin would have actually increased significantly.
Absolutely.
Yeah.
So this wasn't about failing to sell products profitably. It was a specific non-cash accounting decision in one segment, probably to clean up inventory values on the balance sheet. A temporary hit, not a sign of deteriorating core profitability.
That makes sense. And it leads us right into this whole GAAP versus non-GAAP discussion. Management reported the official GAAP operating loss at $11.1 million, but they also gave an adjusted non-GAAP number. How did that look?
Their adjusted operating loss was slightly better, but only slightly, $9.5 million.
Only a $1.6 million difference. That seems small. Usually, companies use non-GAAP adjustments to smooth things out and make the numbers look a lot better, right? They adjust out stock compensation, restructuring costs.
They often do, yes.
Okay.
And the minimal difference here is actually really telling. It speaks volumes about management's approach, and frankly, it adds credibility to their story.
So?
Remember, they talked about using rigorous unadjusted KPIs, key performance indicators. By keeping their adjusted loss so close to the GAAP loss, they're essentially living up to that. They made a conscious choice not to adjust out some major items that other companies definitely would have.
Like what? What did they leave in that adjusted number?
Crucially, they left in the two big non-cash charges we've been talking about. That $9.5 million adjusted loss still includes the $6.8 million stock-based compensation charge and the $3.91 million inventory adjustment.
Wait, really? They didn't add those back?
Nope. If they had added those back, which would be standard practice for many peers trying to show core operational profit, their adjusted number would have looked much, much better. Probably close to positive territory or even slightly positive.
So why didn't they? Why present a non-GAAP number that's still a significant loss?
I think it signals a commitment to transparency and discipline. It aligns with that rigorous KPI's claim. They're effectively saying, look, even with minimal adjustments, we're showing you this loss. The real story isn't about tweaking the operating loss figure. It's about the cash flow.
So they want the market to focus on the $16.7 million in free cash flow, not get bogged down in arguing about which non-cash items should or shouldn't be adjusted out of the operating loss.
That's how I read it. They're avoiding the perception of playing accounting games. They're acknowledging the GAAP impact of these non-cash volatile items, but pointing investors towards the underlying cash generation as the true measure of performance.
That's actually quite a confident stance. It suggests they believe their operational execution and cash story are strong enough on their own. Builds trust, maybe.
I think that's the goal. Let the cash flow speak for itself.
Okay, slide 3. The engine room. Let's move from the accounting nuances to what's actually happening in the different parts of the business. You framed it earlier as a profitable core funding strategic growth and covering overhead.
That's the basic structure, yeah.
Yeah.
You've got established profitable segments generating cash, and then you've got areas where they're investing for the future, plus the central corporate costs.
So let's quantify that profitable core first. Which segments are generating income and how much?
If you take the three main established segments, liquor retail, cannabis retail, and their investments arm, and add up their operating income for the quarter,
Yeah.
they collectively generated $21.9 million in positive operating income.
$21.9 million. Okay, that's a solid foundation. That's the engine.
That's the engine driving things.
Which means if the profitable core made nearly $22 million, but the overall company had an operating loss of $11 million, the difference must be coming from the strategic investments and that corporate overhead.
Exactly. The consolidated loss is entirely explained by the planned losses in the growth segment, cannabis operations, and significantly the drag from corporate costs.
All right, let's break down each segment, starting with the biggest revenue contributor, liquor retail.
Right. Liquor retail is still the revenue giant. Pulled in $139.4 million this quarter and is reliably profitable, contributing $11.2 million in operating income. It's the steady cash cow.
But the report mentioned headwinds. Revenue was actually down 3.6%, and same-store sales fell 2.6%. What's happening there?
Yeah, that's the challenge for this segment. The company explicitly called out continued softness in market demand.
Meaning, people are buying less booze or cheaper booze.
Probably a bit of both. It likely reflects broader economic pressures. Inflation, general uncertainty. Consumers might be cutting back on discretionary spending, maybe trading down from premium brands.
So, while it's still generating good cash, $11.2 million operating income, that declining revenue trend is something to watch. They need to manage that market softness.
Definitely. They'll need strategies to maintain loyalty, maybe optimize their product mix to match shifting consumer preferences in that kind of environment.
Okay, now let's contrast that with cannabis retail. That segment sounded like a real bright spot.
Oh, it absolutely was. A stellar quarter for cannabis retail. They hit new records across the board. Revenue at $85.0 million, record gross profit, and record operating income of $9.1 million.
Wow. So strong growth there. What drove it?
It was a combination of factors. First, same-store sales were up 3.6%, so their existing stores were performing better, likely grabbing market share. But maybe more importantly, they improved their margins.
Yeah.
And the report says this was due to a reduction in promotional intensity.
Less discounting.
Exactly. They didn't have to slash prices just to move product. They sold more and they did it at healthier margins. That suggests their brand is strong, their locations are good, and they're competing effectively without just racing to the bottom on price, which is a problem elsewhere in the cannabis market.
So cannabis retail looks like a key engine for profitable organic growth right now.
For sure. It's probably the most exciting segment in terms of current performance and near-term potential.
All right, next up, cannabis operations. This is the cultivation, processing, wholesale side.
That's right. And the story here is explosive revenue growth up almost 50%, 49.5% actually.
What fueled that huge jump?
Two main things mentioned. First, the contribution from the Indiva acquisition. They make edibles, vapes. Second, they saw accelerating international sales, hitting $4.2 million this quarter.
Okay, so the investments in acquisitions and international reach are starting to show up on the top line, but it's still posted an operating loss, right? $5.4 million.
It did. And this is what we talked about. It's acting as a strategic loss center right now. But importantly, that $5.4 million loss, it's almost entirely explained by those non-cash write-offs we keep mentioning. The inventory adjustment and the asset write-off were booked here.
Ah, okay. So operationally, it's scaling revenue rapidly, but the accounting cleanup is masking the underlying progress on the income statement for now.
Precisely. It's generating potentially high-value revenue streams, especially internationally, while incurring these temporary accounting costs related to integrating acquisitions and scaling up.
Got it. Now, the final piece, and maybe the biggest hurdle to overall profit, corporate drag, a massive $27.55 million operating loss from the corporate segment. That just wipes out all the profit from the core segments.
It's a huge number, no doubt. It's the single largest drag on profitability.
We know part of that is the non-cash stock compensation charge, the $6.8 million related to the stock price jump. That accounts for about 25% of it.
Right. So even if you pull that non-cash item out, you're still looking at roughly,
Hmm.
what, $20.7 million in cash and overhead costs for the quarter, just from the corporate center.
Oof. $20 million a quarter in cash burn just for corporate. What's included in that? Why is it so high?
Well, it covers all the centralized stuff needed to run a complex company like this. You've got executive salaries, head office costs, IT infrastructure for the whole group, legal fees, especially with M&A activity, regulatory compliance across different provinces and potentially internationally, insurance, finance, HR, all the shared services supporting liquor retail, cannabis operations, and the investments arm.
So it's the cost of being a large, diversified holding company.
Essentially, yes.
Right.
And while some level of corporate overhead is obviously necessary, a run rate of over $20 million in cash per quarter is significant. Investors will want to see that number come down over time, or at least grow much slower than the revenue-generating segments.
Is it fair to say they might be investing heavily in building a corporate structure that can handle future growth, maybe even global expansion? And that's why it's high now.
That's likely part of the narrative. To become a global leader, you need a robust central function. But the key will be demonstrating efficiency gains in that overhead as the business scales. They need to leverage that central cost base effectively.
Okay, so summarizing the segments. Strong retail engine doing well, strategic growth areas scaling revenue but hit by accounting charges, and a heavy corporate overhead that needs careful management, though it's also inflated by non-cash items.
It's a good snapshot. And all of this activity, all these moving parts, they rest on the foundation of the company's financial position.
Which brings us neatly to slide 4, financial strength and shareholder rewards. You called their balance sheet a fortress earlier. Why is that such a big deal in the cannabis industry?
It's maybe the biggest differentiator right now. Access to capital is incredibly difficult and expensive for most cannabis companies. Banks are hesitant, debt costs are high, stock markets are skeptical.
Right.
So having a strong balance sheet isn't just nice to have.
Yeah.
It's a massive competitive advantage.
Okay, so what are the key metrics that make SNDL's balance sheet a fortress?
Two things stand out dramatically. First, cash. They ended the quarter with $240.6 million in unrestricted cash on hand.
Wow, nearly $250 million in ready cash.
Ready cash, highly liquid. And second, maybe even more importantly, zero debt.
No debt at all.
No debt. That combination, huge cash pile, zero debt, it's incredibly rare in this sector. It makes them almost immune to rising interest rates that are squeezing other players, and it protects them from the liquidity crunches that can kill smaller companies.
The source material didn't just call it a defensive shield, though. It called it an offensive weapon. Explain that. How is holding cash an offensive strategy?
It's all about having the power to act decisively without needing anyone else's permission or money. Specifically, it enables non-dilutive growth.
Meaning they don't have to issue more stock to fund things.
Exactly. When they see an opportunity, whether it's a big acquisition like those 32 stores they're buying from 1CM or building new Wine and Beyond stores, they can just pay for it with cash. They don't need to go to the market and issue new shares, which waters down existing shareholders' ownership. They don't need to take on expensive debt with restrictive covenants.
That's a massive benefit for current investors. Their slice of the pie doesn't shrink every time the company makes a move.
It's arguably the single biggest protection for shareholder value in a growth-oriented company in a capital-starved industry. This ability to self-fund expansion using internally generated cash flow and existing reserves, that's the structural advantage.
Okay, I have to play devil's advocate for a second, though. Is there a risk of being too conservative? Sitting on almost $250 million in cash, earning very little, especially when inflation is eating away at its value. Could they be missing opportunities by not using some leverage? Maybe taking on a little bit of smart debt to grow even faster?
That's a perfectly valid question. And it's the strategic tension investors need to weigh. There is absolutely an opportunity cost to holding that much cash.
Right.
However, SNDL's strategy seems very clearly focused on disciplined expansion. They appear to be waiting for the right opportunities, perhaps for assets to become available at distressed prices because other, more leveraged companies run into trouble.
So they can be the buyer of choice when others need cash.
Precisely. In a volatile market like cannabis, with regulatory uncertainty still a major factor, maybe conservatism is the winning long-term play. Their cash preservation suggests they believe the best deals might still be ahead. They're prioritizing flexibility and the ability to strike when the time is right, rather than maximizing leverage right now.
That ties directly into their shareholder rewards policy, doesn't it? They renewed the buyback program, but barely used it.
Exactly. Renewing the program keeps the option open, it signals confidence, gives them flexibility. But the actual activity, only 1,800 shares bought back in Q3, shows where their real priorities lie.
Reinvesting for growth.
Reinvesting that cash flow and preserving the war chest for the strategic moves they've outlined in their outlook. Which takes us to the final section.
All right, slide 5, the road ahead. Let's look at what management is saying about the future and where they're focusing their efforts. The CEO, Zach George, talked about transformation and value creation. What were the key messages from him?
He really emphasized hitting that milestone we discussed earlier, not just record quarterly free cash flow, but achieving positive cumulative free cash flow for the first 9 months of the year.
Why is that cumulative number so important?
Because it marks a fundamental shift. It says the company, over a longer period, is now generating more cash than it consumes. It moves the narrative away from cash-burning startup towards self-sustaining business.
Yeah.
That's a huge psychological and financial turning point.
And that underpins their bigger ambition.
Yes, he directly linked this financial resilience to their goal of becoming a global cannabis leader. The message is, we now have the financial foundation and the operational agility to pursue that long-term vision.
Okay, so how are they pursuing it? What's the growth strategy look like? It seems multi-pronged.
It is. They're attacking growth on several fronts. First, there's inorganic growth, M&A.
Right, 1CM deal.
Exactly. The pending acquisition of those 32 cannabis retail stores from 1CM Inc. That's about buying market share, expanding their footprint quickly in Canada, and doing it with cash, aiming for it to be accretive, adding to earnings over time.
Then there's organic growth building stuff themselves.
Yep, reinvesting that free cash flow directly. They specifically mentioned accelerating their physical expansion in Q4. They plan to open 5 more cannabis stores and, significantly, 2 new Wine & Beyond stores.
Wine & Beyond must be a strong performer for them if they're building more.
It seems to be a key format in their high-performing liquor segment, justifying that capital deployment. It shows they're putting money into proven winners.
Okay, M&A, organic builds. What about geographically, international?
That's the third prong. We saw the $4.2 million in international sales this quarter. The report links that directly to finishing the ramp-up of their Atholville cultivation facility.
So that facility is now fully operational and shipping product overseas.
That's the indication. It's producing cannabis designed for international markets, likely medical markets initially. This isn't just about Canada anymore. It's about diversifying revenue and accessing potentially higher margin global markets. The cannabis operations segment is key to enabling that.
And the final piece of the strategy, maybe the one with the biggest long-term potential, but also complexity, U.S. market entry. How are they tackling that given the federal issues?
Right. This is through their Sunstream investment structure. It's crucial, but complex. Because SNDL is listed on the NASDAQ, they can't directly own or operate cannabis businesses in the U.S., where it's federally illegal.
So Sunstream is their workaround. How does it function?
Think of Sunstream as a separate investment vehicle, maybe a joint venture or a specialized lender. It provides capital, both debt and equity-linked financing, to existing U.S. cannabis companies, the multi-state operators, or MSOs.
So SNDL doesn't own the U.S. pot shop, but they kind of own the loan or have an investment stake in the company that does own the shop.
That's a good way to put it. They gain financial exposure to the growth and profits of the U.S. market without actually touching the plant in a way that violates federal law or NASDAQ rules. It's about participating economically while managing regulatory risk.
And the report mentioned Sunstream restructurings. What's that about?
That likely involves optimizing the structure of those investments, maybe converting debt to equity-like instruments, positioning things so that SNDL shareholders get the maximum benefit from Sunstream's performance, and perhaps setting things up for a smoother transition if U.S. federal laws ever change.
Making sure they're positioned to capitalize if legalization happens.
Exactly. They want an established financial foothold ready to go.
They specifically called out Florida and Texas as markets where Sunstream is giving them exposure. Why those two? Seems like very different markets.
They are, and that probably reflects a balanced strategy. Florida has a huge, mature, and profitable medical cannabis market already. Investing there gives them exposure to existing high-volume operations. It's about participating in current success.
Okay, established market. What about Texas?
Texas is the opposite. It's a massive state, huge population, but its current medical cannabis program is very restrictive, quite small. Investing there is more of a bet on the future.
A bet on regulatory change.
Precisely. If Texas expands its medical program significantly, or especially if it moves towards adult use legalization down the road, being an early financial backer in that market could offer absolutely enormous upside. So it's like Florida for current stability and growth, Texas for potential exponential future growth.
That makes a lot of sense. And again, using their strong balance sheet to make these U.S. bets without risking the core Canadian business.
It all comes back to that fortress balance sheet, enabling discipline, strategic moves across multiple fronts, including this complex U.S. play.
Okay, let's bring it all home. We've gone deep into the numbers, the segments, the strategy. What are the absolute key takeaways for you, the listener, from this Q3 deep dive into SNDL?
I think there are three core points to hammer home. First, the illusion versus the reality.
Go on.
The illusion was that headline EPS miss. It looked bad, but it was primarily an accounting story, driven by non-cash charges, including that weird penalty for their own stock going up.
In the reality.
The reality was record free cash flow of $16.7 million.
Yeah.
The company is generating cash, becoming self-sustaining. That trumps the accounting noise.
Okay, takeaway number one, cash flow over GAAP illusion. What's number two?
Takeaway two is the engine. The profitable core of the business, liquor retail, cannabis retail, investments, is working. It generated nearly $22 million in operating income.
So the core is strong.
The core is strong, and it's doing its job, funding the strategic growth initiatives in areas like cannabis operations and covering those corporate costs.
Got it. Profitable engine is firing. And the final takeaway.
Takeaway three is the weapon, and that weapon is the balance sheet. $240 million in cash, zero debt.
Why is it a weapon?
Because it allows them to execute their entire strategy, M&A, building new stores, the complex U.S. investments via Sunstream without diluting shareholders or taking on risky debt. It gives them discipline, flexibility, and staying power in a tough market. It's a key competitive advantage.
So putting it all together, this quarter really underscores why you can't just react to headlines. You need a framework to look deeper.
Absolutely. If you only saw the EPS miss, you'd think it was a bad quarter. But digging in reveals strong cash flow, improving core profitability masked by non-cash items, and a company using its financial strength to execute a clear, multi-pronged growth strategy.
The DAP loss was just one data point. The operational story was actually one of significant progress towards self-sustainability and strategic positioning.
Well said. It's about separating that temporary accounting noise from the underlying operational and strategic trajectory.
Just a reminder, this report is for informational purposes only. It doesn't constitute financial, investment, legal, or tax advice. Always do your own research. And this report was generated by an artificial intelligence model.
Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our library of S&P 500 stocks and NASDAQ 100 library we are building out, and also get priority requests for company deep dives.